Hello and welcome to this video on crypto trading strategies for beginners. In this video, we will be discussing some of the key strategies that beginners can use to start trading cryptocurrencies. Cryptocurrency trading can be a very exciting and potentially lucrative venture, but it can also be quite complex and challenging. That's why it's important to have a solid understanding of the strategies that can help you succeed in this field. We'll be covering a range of topics, including technical analysis, fundamental analysis, risk management, and more. So, whether you're just starting out in the world of crypto trading, or you're looking to improve your skills and knowledge, this video is for you. Part 1. Understanding the crypto market. Before we dive into specific trading strategies, it's important to understand the basics of the crypto market. The first thing to note is that cryptocurrency prices can be extremely volatile, which means they can fluctuate rapidly and unpredictably. This can make trading in this market quite risky, especially for beginners. However, with the right knowledge and strategies, it's possible to mitigate some of this risk and take advantage of the opportunities presented by the crypto market. One key way to do this is through technical analysis. Part 2. Technical analysis. Technical analysis involves using past price movements and other market data to predict future price movements. This can be done through the use of charts and other technical indicators, such as moving averages, trend lines, and Fibonacci retracements. One of the most popular technical analysis tools used in crypto trading is candlestick charts. These charts provide a visual representation of price movements over a certain period of time, such as an hour, a day, or a week. By analyzing patterns and trends in these charts, traders can identify potential entry and exit points for trades. Other technical indicators, such as relative strength index, RSI, and moving average convergence divergence, MACD, can also be used to help identify potential trades. These indicators can help traders determine when a particular cryptocurrency is overbought or oversold, which can indicate potential changes in price direction. Part 3. Fundamental analysis. While technical analysis can be a useful tool for predicting short-term price movements, it's also important to consider the underlying fundamentals of a particular cryptocurrency. This is known as fundamental analysis. Fundamental analysis involves examining the factors that can influence the long-term value of a cryptocurrency, such as its technology, adoption rate, and overall market demand. For example, if a particular cryptocurrency has a strong development team and a growing community of users, this could indicate that it has strong long-term potential. On the other hand, if a cryptocurrency has a history of security breaches or regulatory issues, this could be a red flag for investors. By considering these factors and conducting thorough research, traders can make more informed decisions about which cryptocurrencies to invest in and when to buy and sell. Part 4. Risk management. No matter what trading strategy you use, there will always be some level of risk involved in crypto trading. That's why it's essential to have a solid risk management plan in place. One key aspect of risk management is setting stop-loss orders. These orders automatically sell a cryptocurrency if it reaches a certain price point, which can help limit potential losses. Another important aspect of risk management is diversification. This involves spreading your investments across multiple cryptocurrencies, which can help reduce the impact of any one particular cryptocurrency performing poorly. Finally, it's important to have a clear understanding of your own risk tolerance. Some traders are more willing to take on higher levels of risk in exchange for potentially higher returns, while others prefer a more. Thanks for watching.